So, you ever hear those almost unbelievable stories in trading? A guy turning a small account into a fortune in like no time at all? Well, today we're talking about one that's actually true. The story of trader Larry Williams. We're going to break down the exact strategy he used to turn $10,000 into over $1 million in just 1 year.
Yeah, you're seeing that right. The return was 11,300%. I mean, that's just an absolutely staggering number. It almost doesn't seem real, but it was the result of the powerful mechanical system we're about to get into.
And this isn't just some abstract percentage. This is the real-world result. We're talking about taking a modest $10,000 account and turning it into life-changing money, all inside of a single year.
So that's the big question, right? How on earth did he do it? What was the system? What were the rules that allowed for those kinds of explosive gains? Well, the answer is a strategy known as the LW volatility breakout.
Okay, so the whole strategy, the entire thing, is built on one core indicator. So let's start right there, with the tool that's designed to spot the potential for these huge moves, the Donchian channels.
At its heart, this thing is designed to do just two simple jobs. First, show you when the price is breaking out of its recent high or low. And second, just give you a really quick read on which way the market's momentum is flowing.
And it's super simple to understand. You've got the upper band, that's your trigger for a buy trade. The lower band is the trigger for a sell. And that orange line in the middle, think of it like a center of gravity. It just helps you see if the short-term momentum is bullish or bearish.
Now listen up, because this part is absolutely crucial. You can't just slap this on a chart with default settings. For this strategy, on a 5-minute chart, that length setting has to be 96. That specific number is one of the keys to the whole system. But here's the catch, and trust me, it's a huge one. If you just use this indicator by itself, you're going to get into a world of trouble. Just trading every single time the price touches one of those bands, well, that's a recipe for disaster. And you can see exactly why right here. In a nice trending market, the bands are wide, and the breakouts actually mean something. But look what happens when the market goes sideways and choppy. The bands get super tight, and you get this constant stream of tiny, meaningless breakouts, basically a ton of false signals.
So that brings up the obvious question. If the breakouts alone aren't enough, how do we filter out all that noise? How do we know which breakouts are the real deal, with actual momentum behind them, and which ones are just fakes?
And this is where the genius of the system really shines. See, Larry Williams knew this. He didn't just rely on one indicator. He added layers of confirmation, filters really, to weed out all the bad trades and only focus on the absolute best setups.
The very first confirmation layer is an indicator he actually created himself. It's called the Larry Williams Large Trade Index, or LWTI for short. Its entire job is to just give us a simple thumbs up or thumbs down on the dominant short-term trend.
And here are the settings you'll need. A period of 25 with a smoothing period of 20. And the signal couldn't be easier to read. If it's green, the short-term trend is bullish. If it's red, it's bearish. That's it. No ambiguity, no guesswork.
All right, our second confirmation layer is something you already know well, simple volume. But its job here is so important. It's how we confirm that a breakout isn't just some random price spike. We need to see that big players, that significant participation, is backing the move. We want to see commitment.
So here are the rules for volume. First, you add a 30-period moving average right on top of it. Now, for a signal to be valid, two things have to happen. The volume bar has to be higher than that moving average line. And the color of the volume bar has to match our trade. Green for a long, red for a short.
Okay, let's put it all together. We've got our main breakout signal from the Donchian channels, we have our trend confirmation from the LWTI, and we have our volume confirmation. Now it's time to build the step-by-step blueprint for exactly when to get in and when to get out.
So for a long trade, a buy trade, all three of these things have to happen at the exact same time. It's a checklist. 1, price touches the upper Donchian band. 2, you look down, the LWTI has to be green. 3, you check the volume bar. It has to be green and it has to be above its moving average. If even one of those is missing, you walk away. No trade. Simple as that.
And for a short trade, a sell trade, you guessed it, it's the perfect mirror image. Price hits the lower band. At the same time, the LWTI has to be red, confirming that bearish trend. And finally, the volume bar has to be red and popping up above that moving average, showing that sellers are serious. It's mechanical, it's clear, there's no room for emotion.
Now, getting into the trade is only half the battle, right? For managing it, your stop loss usually goes just on the other side of that middle orange line. But what if the bands are really wide and that makes your risk huge? In that case, you just use the most recent swing low or swing high instead. And for taking profit, we keep it simple. We're always targeting a 2-to-1 risk-to-reward ratio.
All right, so at this point, we have a complete, really robust trading system. But there's one more layer, one final pro-level secret that can take this strategy's performance up another notch and help you sidestep one last hidden trap. So think about it. You get the perfect signal, the price breaks out, the LWT agrees, the volume is there, everything lines up perfectly. What's the one thing in the market that can still stop that trade dead in its tracks and turn a winner into a loser?
The answer? Market structure. Those big, heavy support and resistance levels that you can see on a higher time frame. These things are like the brick walls of the market. And if our perfect setup is running straight into one, odds are it's going to fail. So here's the final filter. You just go to a higher time frame like the 1-hour chart and you draw in those obvious major support and resistance zones. And the rule is dead simple. You do not take a trade that's setting up to go directly into one of those levels. Now, here's a little pro tip. If you see the price break through one of those major levels first and then you get a setup, that's an even more powerful signal of momentum.
And really, this all boils down to one final, super important lesson. The best strategies aren't just about a collection of signals from indicators. The real edge, the thing that separates good from great, is understanding the broader market context. It's not just what your indicators are telling you, it's where on the chart they're telling you. And that right there, that's the difference maker.